Welcome to The Explainer. Today, we're pulling back the curtain on a systematic daily routine that institutional-style traders use to find those really high-probability setups. We're going to go from the big picture theory all the way down to a super precise entry model, and it's all built on one single powerful idea. Okay, let's start with a concept that just changes everything. The market is not random. It's not chaos. It actually operates on a schedule. Just like the slide says, every single move is coded to happen at a specific period of time. You gotta think of it like an algorithm designed to deliver price with, honestly, ruthless efficiency. Once you really let that sink in, the whole chart starts to look completely different. So, what does this mean for us? It means our job isn't to guess or to gamble, it's to understand the market's daily schedule. We need to figure out why price is moving and what its agenda is for that day. And that is how we move from just randomly clicking buttons to trading with a genuine edge. This brings us to something called the Interbank Price Delivery Algorithm, or IPDA for short. Now, don't get hung up on the name. It's not a single piece of software you can go find. It's better to think of it as the market's operating system. It's the underlying logic that purposefully delivers price to specific levels at specific times to achieve a very specific goal. And what is that one primary objective? Well, it's right there. To seek liquidity. You have to ask yourself, why does price even move? It moves to find fuel, and that fuel is liquidity. It's all those pools of buy and sell orders, especially the stop losses, that the big institutions need to fill their massive positions without causing the price to run away from them. The market is basically a heat-seeking missile, and liquidity is the target. All right, let's get into the first practical step in our daily routine. This is how we start to build our case for the day. Before the main session even kicks off, we need to figure out where the market is most likely headed. We call this setting the daily bias. And where do we start? Well, here's rule number 1. All analysis starts on the higher time frames. Always. The daily and the 4-hour charts carry the most weight. They show you the bigger institutional footprint. Trying to day trade on a 1-minute chart without knowing this broader context, that's like trying to navigate a ship in a storm without a compass. You're just going to get tossed around. This top-down approach gives us a super clear roadmap for the day. So, step 1, we start way out on the daily and 4-hour to get our general direction. Are we looking for buys or sells? Step 2, we zoom into the 15-minute chart to pinpoint those juicy liquidity pools we just talked about. Those are our targets. And then finally, step 3, we drill all the way down to the 1 or 5-minute charts to find a precise, low-risk entry. See? It's a process of elimination, moving from the big, general picture down to the specific. So, to find our target for the day, we have to ask ourselves one simple question. Where is the draw on liquidity? This is the magnetic north on our compass for the session. It's usually a really obvious area, like a clean, old high or low, where you just know a ton of stop-loss orders are clustered. The IPDA, that algorithm we mentioned, is literally engineered to hunt for these zones. Now, this is a really cool visual trick. You can actually see where the target is. Look for price action that's smooth. You know, those really clean, untouched highs or lows. That's where untapped liquidity is just sitting, waiting. On the flip side, see that rough or jagged, messy price action? That's history. That shows you where liquidity has already been swept up. The market's already done its business there, and it probably isn't coming back anytime soon. Okay, so we've got our where, the draw on liquidity, and our what, our bullish or bearish bias. I'm telling you, none of it matters without the win. This is the most critical piece of the puzzle, the element that governs everything else. Timing. The highest probability setups, the A-plus trades, they almost always happen during very specific windows. We call them kill zones. These are the hours when institutional activity is at its absolute peak, right as major financial centers like London and New York open for business. If you're trading outside of these windows, it's like fishing in a pond where you know there are no fish. You're just wasting your time and your capital. I cannot stress this enough. If you take one thing away from this whole explainer, please let it be this. This is the golden rule. A technically perfect-looking setup that forms at the wrong time of day is a low-probability trade. Period. Full stop. Time always comes first. The price has to be at the right level at the right time. This timeline here is basically the algorithm's morning playbook for the New York session. And notice the first step between 7 and 7:30 a.m., the manipulation phase. This is a false move, often called a Judas swing, because it literally betrays traders, tricking them into taking the wrong side of the market.
Once that trap is set and liquidity has been engineered, then the real true move for the day can begin.
So let's put it all together now. We've got our bias, we've picked our target, and we know our timing window. So how do we actually pull the trigger and get into a trade with a high probability entry model? One key institutional level you want to keep an eye on is the new day opening gap, or NDOG. It's really simple. It's just the empty space on the chart between yesterday's closing price and today's opening price. The market often seeks to revisit this gap to rebalance price, which makes it a really powerful magnet and a potential hotspot for a trade setup. This three-step model is your entry blueprint. It's a simple 1, 2, 3. Step 1, you wait for that liquidity sweep, that Judas swing we just talked about. Step 2, you look for a powerful, energetic break in market structure in the other direction. This is the confirmation that the big players have shown their hand. And step 3, you don't chase it. You wait patiently for price to pull back into an area of imbalance, like an order block or a fair value gap, and that is your precise point of entry. And this is where we get surgical. By drilling down to these lower time frames, like the 1 minute or 5 minute, during our entry window, we can find these incredibly precise entry points. Why does that matter? Because it allows us to use a much tighter stop loss, which dramatically reduces our risk and seriously juices the potential reward on the trade. Okay, we've covered the entire setup from bias all the way to entry, but absolutely none of it matters without this final and, frankly, most important piece of the entire routine: strict, non-negotiable risk management. You have to think of these rules as the laws of the land. First, fixed risk of 1% or less protects your capital so you can survive the inevitable losing streak. Second, staying out during major news events keeps you from pure gambling. Third, you gotta have patience. This process takes time to learn. You can't rush it. And finally, your stop loss isn't just a random price. It's the logical point on the chart that proves your entire trade idea was wrong. Following these rules is what separates the pros from the amateurs and keeps you in the game long enough to win. So let's end with this thought. By understanding and accepting that the market runs on a schedule, that it's seeking specific things at specific times, you can fundamentally change your entire approach to trading. You can finally shift from just reacting to every little tick on the chart to actually anticipating the market's next logical move. So the question is, are you ready to get in sync?